Hi, I'm Suzy Rhoades with PassMasters. Welcome to this week's Questions of the Week. This week, our topic is Basic Economic Concepts 2. You can expect this topic to appear on the SIE exam and the Series 65. We will be taking a 10-question topic quiz from within one of our PassMasters Securities courses. Let's check out our learning management system. All of the following are lagging indicators, except rewording the question without the except. Which of the following is not a lagging indicator? Interest rates, business spending, unemployment rate, or building permits. So 3 of them are lagging, and 1 of them is not. Building permits is a leading indicator. So you'll click what you believe is the correct answer, click check answer. You know it's correct if you get that green check mark. If you would like to read a little bit further about it, click show explanation. You can also click all of the following are lagging indicators to listen to an audio explanation. So that's me. Every one of our questions has an audio explanation. So interest rates, business spending, unemployment rate, those are all lagging indicators. So initial jobless claims are leading, but unemployment rate is lagging. Building permits are leading indicators. Which is the root cause of inflation? Choices include too many dollars chasing too few of goods. I like that, but let's check all of them before we pick what we believe is the correct answer. Too few dollars chasing too many goods, low interest rates, or high interest rates. So the root cause of inflation, too many dollars chasing too few of goods. So inflation, things get more expensive. Everything gets more expensive. In general, the largest component of a country's balance of payments is the balance of trade, which most accurately describes the balance of trade. Foreign investment versus domestic investment? No. Imports versus exports? Balance of trade. Yes, let's check the others. Assets versus liabilities, income versus expenses. No. So the balance of trade, does a country bring in more goods? Those are called imports. Or do they manufacture goods that they sell to other countries? We call those exports. So if a country like the United States imports more than it exports, we have a balance of trade deficit. When a country like China exports more goods than it imports, they have a balance of trade surplus. So there is more to a country's balance of payments than just the balance of trade. However, the test can sometimes act like there's just this one part, and that's okay. You have to know a lot of information to pass these exams, so they're not going to get too in-depth on this concept. In the United States, we use blank to measure inflation. Choices include CPI, PPI, GNP, or GDP. We use the Consumer Price Index to measure inflation, CPI. So measures the cost of a basket of goods, same basket of goods in various cities across the United States. So when the cost of the basket goes up, we have inflation. PPI is measuring the goods at the producer level. GNP is gross national product. GDP is gross domestic product. We use CPI to measure inflation. Which of the following is not included in the GDP of the United States? Government spending, personal consumption, foreign investments, or gross exports. It is gross exports that are not included within the GDP of the United States. Government spending is included, personal consumption, foreign investments, yes. It is net exports that is included within the GDP of the United States, not gross exports. So what the heck? Let me show you. So when we talk about a country's balance of trade, I mentioned this already. We look at two things. We look at imports versus exports. And when we are a country like the United States, we import more than, so our imports are greater than our exports. And that means that we have a balance of trade deficit. So we have this outflow of money out of the United States because we consume cheap goods that are produced primarily in China, right? It's true. So when we look at China, imports are less than their exports, which gives China a balance of trade surplus. Balance of trade surplus. So another way of saying this is the United States, we have net imports, and China has net exports. So a country that has a surplus in their balance of trade, that amount is added to that country's gross domestic product. But we don't have that. We have net imports. So with a country like the United States, where we have net imports, our net imports decrease our GDP. When a country has net exports like China does, that will increase the country's GDP. So going back to the question, gross exports are not included within the GDP of the United States or of any country because you have to account for the exports versus the imports. Thus, net exports would increase the United States GDP. We don't have net exports in this country. We have net imports, which, remember, reduces our GDP. A Japanese-based solar panel manufacturer created $50 million in revenue last year in the state of Iowa. How much did this company contribute to the GDP of the United States? Gross domestic product includes the value of goods and services that are produced within a country's borders. So it would be 50 million is included within the GDP of the United States. How much would be included within the GDP of Japan? Nothing, because it's not within Japan. How much of the 50 million would be included within the United States gross national product, GNP? None of it, because the company is not American. How much of the 50 million would be included within Japan's GNP? 50 million. Gross national product doesn't care about the boundaries of a country. It cares about the ownership of the company. High inflation blank a dollar's buying power. Do we like high inflation? We do not. We do not like it when gas gets more expensive and houses get more expensive and milk is more expensive and everything gets more expensive. So does it enhance, increase, decrease, or have no effect on? High inflation decreases a dollar's buying power. A budget surplus occurs when? I always want a surplus. So imports exceeds exports? No. Government tax revenues exceed government expenditures. So surplus, yes, it's when tax revenues exceed how much the government spends. So balanced budget, they'd be equal. In a deficit, they would be spending more than they're creating in tax revenue. To determine if there is inflation in the economy at the producer level, you would look at which of the following: PPI, GDP, real return, or CPI. It is the producer price index that measures the cost of goods at the producer level. Initial claims for unemployment are which type of indicator? So the test wants you to know a little bit about the various types of economic indicators. Initial claims are leading economic indicators. So leading indicators show us where the economy is heading in the next 3 to 12 months. Coincident indicators change with the market cycle that we are currently in. So current indicators are sometimes called. Lagging indicators, the economy will already have moved to a new phase, and these indicators will take 3 to 12 months to catch up to show. So to go negative, if the economy is going bad, the lagging indicators won't be negative for 3 to 12 months after we already entered that phase of the business cycle. So you don't have to memorize every one of the economic indicators, but you do need to know just a little bit about maybe a couple of each of them. That would be very helpful for these exams. That's it for this week's questions of the week. We had basic economic concepts 2. Give this video a thumbs up if you learned something. Be sure to subscribe to our channel and turn those notifications on. If you'd like to check out our securities course offerings or to enroll in any of our programs, there is a link found in this video's description. Keep up the good work. I hope to have you as a student soon. Happy studies. You got this.